Good morning, everybody. Thank you very much for joining us today for our wrap-up of 2021. And what a year it's been. We're starting today with a Q&A session with our advice team, and then we're going to move on to an economic outlook from David Whitby of Bennelong Funds Management. And thank you very much, David, for joining us today. Look, for those of you that don't know everybody, all these smiling faces in front of you on the screen, I'll just quickly go through. Michelle Shembry. Michelle's in our workplace financial advice team. Harry, I don't know if everyone has the same view as me, but I'll just go left to right. Harry Tong. Harry's our mortgage broker at Lifestyle. David Whitby from Bennelong Funds Management. Jackie is a superstar financial advisor with Lifestyle, as is Kieran and Terry. Myself, and Jenny is the newest addition to the team. She's an advisor who's in her professional year with us. So I thought it'd be nice for you to all get to know us all a little bit better. So I'm going to start with some questions of the team. But before I do that, I thought I'd just give a little bit of a background on the year. It's been an incredibly busy year for us. And look, if we all look a little bit tired on this video, it's because we are. I think we're all really looking forward to a Christmas break. As well as our personal clients, Lifestyle's one of the few remaining workplace financial advice businesses in Australia. And we started in workplace financial advice in 1992, and we're really passionate about it because we get to help people in all stages of their lives. And, you know, talking to members of employer super funds or, you know, employees of our employer clients, you know, the earlier we get to talk to them, the more impact we can have on their lives and the more that we can do to help. And it's something that, as I say, we're passionate about. And the team, which is Michelle, Christy, Tara, and Chris, they do an amazing job. And look, this year, the workplace team have engaged 4 new corporate clients on fee-for-service basis. They've conducted 4 benchmarks and tenders for workplace super and 1 group insurance benchmark. They've installed 3 new group insurance policies. So in a period of COVID lockdown, they've exceeded all of my expectations and done an amazing job. We also transitioned our domain clients. We acquired the domain financial advisor business about 5 years ago, and it was under Charter, which is an AMP company, and we've transitioned all of those clients to Fortnum over the last 12 months. And on top of that, we've actually engaged with around 70 new private client families this year, which has got to be a record for us as a business. So it's been an amazing year. We've grown really strongly, and frankly, next year looks to be even busier. So look, a big thank you to all of our clients, to our new clients, and especially to our loyal long-term clients for sticking with us for another year. We obviously wouldn't be here without you. And look, to all of our wonderful team, I thank them for their support. It's a real group effort, and we've got a great team. Anyway, I'm going to start with a question for, as I said, our newest advisor, Jenny Moskman. I've had the pleasure of mentoring Jenny in her professional year, which looks like it's going to be a professional 18 months. But anyway, well, that's another matter. But Jenny is an experienced financial services professional, but she was living overseas for a few years, and because of that, she's had to go through the professional year program to basically re-qualify herself under the new rules that we have in Australia. She's a wonderful addition to our team. She has a lovely, warm and caring nature, as you can see from her lovely smile. And she's a mum of 3, lives in Roseville. So I wanted to start by asking Jenny what's involved in the professional year program.
Thanks, Gareth, and hi everybody. The professional year program is a structured one where each quarter I work on the core competencies and activities in areas such as in technical knowledge, client care and ethical behaviour. And you do need to be able to demonstrate each of these abilities before you move on to the next quarter. And throughout the entire year, I have the opportunity to work alongside my mentor, Gareth, on all client files. And I do consider myself very fortunate to be able to leverage off Gareth's extensive experience in this industry. And yeah, to date, I've learned a lot. It's been an incredible year. It's a program that's far more rigorous than what was required previously. And I do believe that it lifts our industry standards, which is a great outcome for all clients seeking advice.
Yeah, there's a lot involved, isn't there, Jenny?
Oh, yes, I forgot to add that at the end of it all, we would have worked together, Gareth, for 1,600 hours, over 1,600 hours in total. So I'm sure you'll need a break from me.
I'm looking forward to Christmas. Not so much a break from you, Jenny, but I'm looking forward to a break. So what have been your biggest challenges this year, professionally and personally? Because it has been a tough year for everybody.
Yeah. Look, I started the year probably like everyone else, feeling really positive. And in the first half of the year, I completed a master's in applied finance, which I was thrilled about. However, in the second half of the year, with the COVID lockdown in Sydney, that for me brought about a set of personal and professional setbacks. I found that my support network of family and friends was severely impacted, and just finding that right balance between juggling my career, my professional year, and running a busy household with young kids that couldn't attend school, that was relentless, and it was really exhausting. I found some solace at work during this difficult period. It was a part of my life that I could feel that I had some control over the outcomes. That was in contrast to what was happening at home. I had little control over the kids and my husband. And I found that work was incredibly supportive. It was just a combination of the provision of some mental health days, counselling sessions, and occasionally some thoughtful gifts just arriving at my doorstep. And I felt very much supported and valued, and that had a huge impact on my well-being.
Oh, thanks for that feedback, Jenny. That's good to know. Yes, controlling husbands is very difficult, and I must say, I have the greatest admiration for all of the working mums at Lifestyle. I don't know how you do it. I know you've all been pulling your hair out this year with homeschooling and everything else that's been going on. It's really challenging, and the working dads, of course. But anyway, so on to you, Kieran. Kieran's also a great guy. We're really lucky to have him. He's been with us for about 18 months now, and came to us with a lot of financial services experience, as well as a lot of skydiving experience. So he's potentially a temporary Australian. But anyway, Kieran has been looking after a lot of the domain financial services clients, updating their advice and transitioning them across to a new licensee. So Kieran, what have been the highlights for you working with these wonderful people?
Highlights, well, apart from being able to wear board shorts under the table in the client meetings, which has been great, and somehow I completed my MBA throughout the course of the year as well with all the turmoil. Look, it really has been a tumultuous year for everybody. Lots of transition, lots of regulatory change. It's been quite challenging for us and for our clients, and I totally appreciate that. But I'm glad we've now managed to come through stronger than ever. Working with the domain clients has just been fantastic. I know there's many on the webinar as well, so I'd like to say thanks to you all for being so great to work with. I know it's not easy changing advisor and re-establishing that trust, but we've done that really well in a short period of time, and I've built some great connections with those clients already.
Yeah, that's great, Kieran, and we know they're in good hands with you, mate. So do you have any particular success stories from the year that you'd like to share with us?
Success story, well, I think on portfolio management alone, we've done really well. A lot of the returns have been driven by market recovery, post-COVID, of course, but beyond that, we're providing great investment performance above those benchmarks. So I think everybody's part of that success story. Strategy-wise, though, one of the biggest client wins we've been having this year is we've helped many people reduce their capital gains tax bills through the sale of their investment properties. And we've done that by tapping into a lot of the unknown or lesser known superannuation strategies for tax offsets. And in many cases, we're saving tens of thousands of dollars for our clients. So definitely a lot of very happy clients throughout the course of the year. But mostly, I think I'm just really proud of the successful domain transfer overall, and the fact that we've been able to get everybody, well, almost everybody across onto our enhanced portfolio services and tapping into the lifestyle investment committee. So yeah, undoubtedly everybody's going to do far better than they were before. And yeah, looking forward to delivering on that further into 2022, which hopefully will be a very unextraordinary year.
Yeah, thanks, Kieran. I think the domain clients will be far better off now, that's for sure. So on to a veteran, a lifestyle veteran, Jackie. Jackie's been with us for several years. Look, those of you that are fortunate enough to work with Jackie will realize that he's quite a character. I'll never forget my first interview with him. I thought this is either going to be really good or it's going to be really bad, but it's turned out to be really good. So he's also very professional and dedicated. He's a great part of the team, and he does a lot in the background as well with our investment methodology and helping us put all of that together each year. So Jackie, what is one thing that individuals could do you think, to help their own financial success?
Thanks, Gareth. Unfortunately for you, you'll be stuck with me for a very long time.
I hope so.
Well, financial success, it really means different things for everyone. But one thing that every individual can definitely do to help their own financial success, it's actually quite simple. And it is by, keeping on top of your own finance by setting up a budget at the beginning of each financial year or calendar year. Most people find budgeting quite boring. I mean, it is a pretty dry topic, but it is so simple and such a powerful tool that anyone can do and help you take charge of your own financial future. What does it do? It obviously helps manage your money so you can cover the essentials, work out what's left over to save or do something else. It really helps you understand what's coming in. You'll be surprised that some of my clients don't even know how much they're earning. So that's a good start. And you work out how much money is going out, what you can afford to make sure you have some form of surplus left at the end of each month or every year. And when you find additional savings in your budget, you can then have a think about what you want to do with it, whether to pay off your mortgage, invest the savings, or maybe go on a holiday. One of the biggest benefits of budgeting, it really allows you where the money is going, especially discretionary expenses. I'm a little bit crazy. I track my expenses at the end of every month, and I'm always surprised by how much money I spend on alcohol. So at the start of every month, I will slow down on that and maybe not buy a new bottle of whiskey at the start of the month, but I usually revert at the end of the month.
So day 2 is a problem. Jackie, maybe you might be able to have a chat with my wife, Carmel. You might be able to help her out with that too. But look, it's very sound advice, not to make light of it. And look, I know 2022 is going to be a massive year for you. You've got some big personal things planned as well. Tell us what you've got planned for the festive season.
I've got plenty of things planned. Well, first of all, I will be getting married in March 2022. My partner is Sandy, lucky her. But one of the first things that I will do is I practice what I preach. Me and Sandy and I will be setting up a budget together as a team for the very first time. She will, keep me in check in spending stuff on useless stuff, and I'll keep her in check and stop buying shoes and clothes. But life is obviously not just about money and budgeting. With such a tough couple of years that everyone have went through, it is very important that we all rest up, have a bit of fun, and misbehave. And the couple of weeks break during Christmas and the festive season, I will use that as an opportunity to start planning for our wedding. So on all those days that I'm not misbehaving, I will spend time emotionally supporting Sandy so that she can go plan for our wedding.
Good on you, mate. And look, I've known Sandy for a few years now, and I think she's one of the few women that I would say probably won't leave you after having a discussion about budgeting. She's such a patient, lovely person. Anyway, Terry, the birthday boy. It's
Hey, Gareth.
Terry's birthday today. He's made it through another year, 21 again.
It's come around nearly 3 times, actually.
Yeah, no, don't count. So, Terry, like myself, you're a bit of an old timer in financial services. You've been around the traps for a while. After all of these years with your wonderful experience, what is it that you find most satisfying about what you do with clients, your work?
Yeah. Thanks, Gareth. Hey, hello to everybody. Look, one of the aspects that I particularly like in my job is managing the retirement piece with our clients. It's a big issue, and one of the key aspects of retirement is actually understanding about what we call longevity risk, which is basically making sure that we don't run out of money before we pop off. So that's an important issue, and we've got to make sure that all our clients have a happy lifestyle, have fun, and don't run out of money at the end. What we do is we basically set ourselves up from terms of a planning point of view. We basically break down retirement into 4 aspects. So we talk about pre-retirement. That's the toughest part. That's building the funds to have enough money to last the distance. Then we call it early retirement, 62 to 70 sort of years, that sort of bracket, where effectively this is the most time where we expend the most money and we're the most active. And then we call it middle retirement and late retirement. So retirement is not really just a single phase in our lives. It's actually a multiple number of phases, and we've got to make sure that we budget through each of them. So I enjoy going through all of that activity and making sure that our clients can get through all of that and have a happy and a comfortable retirement. That's our aim. So that's what I get out of bed for in the morning, Gareth.
Good on you, Terry. And may you keep getting out of bed for many more years to come.
Thank you.
So moving on to workplace financial advice. Now, Michelle, the lovely Michelle is representing the WFA team today. And similarly, Michelle, you must have been with us now for 5 or 6 years. Is it 6 years yet? Yeah.
6 in May.
Seems like 10, I suppose, but 6 years. Michelle does an awesome job. And look, as I mentioned before, it's been a massive year for our WFA team. They've done incredibly well. And workplace advice has been a large part of our business since 1992, when we started assisting employers and their employees. So, Michelle, in last year's client briefing, you spoke a bit about how the WFA team needed to adapt to lockdown. Obviously, you couldn't be on the road and at work sites seeing people you weren't allowed in. So Lifestyle had to quickly adapt to delivering information and education digitally, and I think this was a tremendous success. And I think really we had more penetration to people that we hadn't managed to speak to before. Has this lockdown been the same? Has your experience been the same this year?
Good morning, everybody, first of all. I think, Gareth, in short, absolutely not. It hasn't been the same this year. So I think by the time that we got through the first lockdown last year, we noticed that employees, because most employees were working from home, everything was being delivered to them digitally. So we noticed that for the majority of employees that they were experiencing virtual exhaustion. So digital was not going to work this time around. The last lockdown, we experienced a lot of volatility in markets, which meant that superannuation members were engaged and they needed that support. So engagement levels were very high during that online education. We definitely seen this year in the second lockdown, we've seen those online education engagement levels drop significantly.
So, yeah, I guess that makes sense, because I think if you work all day in front of a camera, you know, on a computer, talking to colleagues and clients, you probably don't want to do it at night or otherwise, you know, unnecessarily. But Other than online education, have you seen, do you think, more or less engagement from employers and employees this year?
Definitely more from both. So probably the most engagement that we have ever seen in my 5.5 years here at Lifestyle. So I think with regards to employees, where we've seen the engagement from them is on an individual basis. So where we've seen their online education numbers drop off, we've actually conducted more individual and more one-on-one appointments this year than we ever have before. The focus has definitely been more of financial planning focus. So people wanting to protect wealth, accumulate more, and to make sure that they're set up to be safe during a financial crisis, and they're better prepared for their futures. With regards to employers, we have seen significant legislative change for them to navigate over the last couple of years. So we're always trying to make sure that our employees are on the front foot and that they can be prepared and can adapt to changes. So definitely increased engagement from both.
Yeah, look, on the subject of legislative change, my goodness, there's been so much. I mean, on all aspects of financial services, it's just ridiculous, to the point where, you know, working from home, if I've got to send something to clients by mail, the envelope's this thick now with all of the stuff that they have to sign, all of the different statements, and, you know, it should be one signature, right? But anyway, how has that impacted things? You know, like the Apra performance test is one that I think was really misunderstood. How have employers reacted to that?
I think, well, with regards to the performance test specifically, we've had a number of things change over the last couple of years. So that includes contribution caps have increased as of 1 July, changes to super strategies, how superannuation funds provide insurance to their members. But as you just mentioned, the passing of the Your Future, Your Super government proposals. So these proposals were in the 2020 federal budget and are now law. So one piece of this legislation is the annual performance test of default superannuation investment options and their performance. The Australian Prudential Regulation Authority, or Apra, now conducts an annual performance test for default MySuper products. This is a test where they tested 7-year performance to 30 June this year, and they test against a benchmark with overall performance, including administration fees. Out of the 76 funds that were assessed this year, 13 of those funds actually failed the test. So our employers have definitely needed us more than ever before to ensure that, you know, risk management compliance requirements are met, but more specifically that they have communication that they need and their employees have communication that they need to be able to explain what these changes actually mean in layman's terms, because we have found that the communication that has come from the superannuation funds and from Apra, specifically around the performance test, has been quite difficult to navigate through.
Yeah, you've done an awesome job, the whole team has. And look, I think one of the things that I think is great about dealing with us as a firm is that, you know, one phone call, you get your questions answered. You're not into a call center. You're not on hold for hours waiting for someone at AMP. Or did I say that? But some of the fund managers, oh my goodness, it's just ridiculous. Anyway, thank you, Michelle. On to Harry. Harry is our illustrious mortgage broker. He's a great man. He loves helping people. So please reach out to him if you think he can help. He's one of a kind, Harry. I know when I was looking to bring a mortgage broking service into Lifestyle, it took me a long time to find the right person, and we definitely did. So, Harry, how have you seen the property and lending markets this year? This is something that's close to everybody's heart.
Yeah, thanks, Gareth. Hi, everyone. Yeah, look, 2021 has been, you know, a very strong year for property prices. Good for those that own a property, probably not so good for those that have been looking. We had a lot of momentum coming into the year from the previous year, and prices just kept going up every month. The lockdowns actually didn't slow things down and probably even help pump up the prices even more, because a lot of sellers were holding back listing their properties, waiting for lockdown to end. And we've seen that in recent, in the last couple of months, as we've come out of lockdown, there's a lot more listings and prices have sort of softened a bit. Auction clearance rates have come down a bit. We saw a lot of owner-occupied purchases and first-home buyers in the market earlier in the year, but as prices kept going up, a lot of them were priced out, especially first-home buyers, and a lot of investors have come back into the market, so that's helped fueling it. Look, at the moment, things have softened a bit. You know, we've had regulators come in and pump up or increase the assessment rate, so borrowing capacity for most people have reduced a bit, and hopefully the momentum hopefully we'll see a bit of more flattening going forward of prices, because it just cannot keep going up like it has been. But 2021 has been a really strong year. 21% or more growth for the capital cities, and even higher for regional areas, as I guess many people are able to work remotely. They're moving to regional areas where they can enjoy the lifestyle rather than being locked down in the cities.
Yeah, look, I know some of my clients have told me the value of their properties and what they've sold properties for. It's just been phenomenal. I think 21% is on the low side.
That's the average.
Yeah, that's right. And look, like always, I guess, Harry, knowing how to put a loan forward to a lender is one of your key skills, and helping people actually get through an assessment and be able to borrow money or get as much as they need is one of the big things. But look, mate, what do you think the outlook is for the next 6 to 12 months?
Well, I think as we're coming to Christmas, there's been a lot more listings in the last couple of months. Prices have sort of more stabilized. The pendulum has probably swung a bit more towards for the buyer. There's a lot more properties on the market for them to choose. Hopefully that going forward, there's early next year, prices will probably start to soften a bit. The forecast from a number of banks has been that we'll still get a small rise next year, and then a fall in 2023. I guess the two biggest things next year, there might be more regulatory changes to try and slow things down even more. So we've had the assessment rates go up a little bit set by Apra, and that has reduced people's borrowing capacity. There's also talk of debt to income ratios where the banks are capped by on the multiple, or how much they can lend you based on your income. So I think at the moment some banks will do up to 7 times, some will only do up to 6 times income, and they might put a cap on that, and that will reduce everyone's borrowing capacity, and that should flow through to house prices over time. I guess the other big thing is rising interest rates. All the banks have increased their fixed rates in the last 3 months by 0.5% to 1%. You know, I mean, I've had the 3-year rate for one of my customers from the time we applied for the loan to the time that he found a property and we're going for formal approval has gone up over 1%. So wow. That's going to flow through to, you know, I guess potential buyers, and you know, they're going to be a bit more cautious. There's a lot of people that are on fixed rates that were fixed below 2% 12 months ago or earlier this year, and as they come off their fixed rates next year, they're going to get a huge shock. They're going to get a rate increase no matter what, because they won't be able to relock it for less than 2%. So that's going to probably influence the property prices going forward.
Yeah, take a bit of heat out of it. Yeah, look, I noticed I heard this morning that the US Federal Reserve met last night, and because I think the stock market, the US market, was a little bit sort of tenuous about what might have happened, but the US Federal Reserve is saying that they plan 3 rate increases next year. So I think if the US does it, we'll probably follow, which is interesting because the Reserve Bank said nothing till 2024, right? But anyway, I guess we'll see what happens. But
yeah.
So thanks, Harry. Thanks, everybody. You can all turn your cameras off now. Thank you, because we're going to focus on David, David Whitby. It's my pleasure to introduce David from Bennelong Funds Management. We added Bennelong, the Bennelong X20 Fund to our portfolios over the last year, and over that period of time, it's outperformed the index by over 10%, and it has done that consistently for the last few years, which I guess brought it to our attention. So we're really pleased that we've been associated and we've done that with Bennelong. It's been great for our clients. So David, you're going to give us a bit of an update on Bennelong itself, and then an outlook for the Aussie market and maybe global market to an extent, and some stock stories. Is that correct?
Indeed, Gareth, and touch on some of the things that you have just mentioned with regards to the overnight activity from the Fed.
Oh,
and with
okay, awesome.
Great.
Yeah.
And what Harry was just sort of alluding to there. So first of all, just a big hello and thank you to you and to the rest of the Lifestyle Financial business, and to all of your clients today as well. A big hello to you. But thanks again to Lifestyle for that tremendous support that you've shown us this year. There are 100 different fund managers out there all wanting a slice of your clients' money, so for you to select us, really appreciate that. And to all the clients as well that are invested with us, it's a real privilege for us to be managing part of your investment portfolios, and we know that we've got a responsibility to get you the best return. So thank you very much for your support, and I'll just do my technical part here that I hope I don't stuff up on the floor there. So as Gareth was saying, so I work for Bennelong Funds Management, so I represent a number of different investment teams, but our flagship team is called Bennelong Australian Equity Partners, and we manage what's called, one of our flagship funds is called the X20 Fund, and that's really what I'm here today to speak to you about, as to how it's positioned, it's performed, some of the stocks that are in the portfolio, but as Gareth also said, to give you some insights from the investment team as to how what their thoughts are on the market going ahead, because there's obviously a hell of a lot of things going on in the world at the moment. So just very briefly, so that you know who is managing your money. So Bennelong Australian Equity Partners was formed in 2008. They're managing over $11 billion, and that is for clients such as yourselves, but also for super funds, insurance companies, and also for self-managed super funds as well. The team is led by Mark East. Mark is the CIO of the firm, and he's then backed up by 7 very capable and highly experienced analysts. Now, I spent some time over the last week or so with Neil Goldston Morris, who you'll see there, sort of the third one down. Neil is the team's senior analyst and macro strategist. He's essentially Mark's right-hand person. Neil's been in the markets for over 40 years, in his mid-60s. You can chat to him about anything, but just incredibly insightful. And then I also spoke to one of the other senior analysts, Kieran Season and Brad Clibben, just to get some insights too on some of the stocks that we're going to briefly chat about. So looking at how the team invests, so you've just got an idea of how they're putting together their portfolio. So it really is looking and what they're actually looking for in a company. They're really focused on high quality growth companies that are reinvesting back into themselves. So they're not focused on big dividend paying companies. They're rather positioned for long-term capital growth. They run really high conviction portfolios like the X20 Fund. So when they take a position in the company, they're not really there to muck around or take a small little index position. They're really taking a big high conviction position, and to get that high conviction, what they're doing is they're having endless meetings with the companies that they invest in. So with the CEOs, with the CFOs, the COOs, but also they're speaking to these companies' competitors, the suppliers, their distributors, to ex-employees. We use a third-party special network as well to tap into. Really just, and also a hell of a lot of data feeds as well, really trying to find out who's lying to us, because in any of these meetings with each company that you're meeting with, they're lying to you to some extent. They're saying something which isn't true. So you're trying to work out exactly what's going on before we take one of these big positions. And also just in terms of how we define this term quality, because that gets used a lot within the industry. A lot of different market commentators and fund managers have a different term about quality. We just try and keep it pretty basic, really. It's looking at having a company that's got predictable earnings, having a sustainable business, having some form of competitive advantage or intellectual property, strong cash flows, having a really clean balance sheet, and that's really important as we move forward into this new interest rate cycle we get going into. And then very importantly, having some form of having a company that's got very trustworthy, capable and honest management as well, which can be the most challenging times at things. So what is this thing called the X20 Fund? So you've all more than likely got exposure to the top 20 stocks, so the largest 20 stocks on the ASX. So think the banks, think the resource companies, Telstra, the insurance companies as well. So the X20 Fund, as the name would suggest, is investing outside of the top 20 funds. So it's more of a specialist fund. It's what we call a mid-cap fund. So middle-sized companies is what we're looking to. So it's a real specific role player within your portfolios. For us, mid-cap companies or middle-sized companies are the ones that are the sweet spot. They're really offering you a lot of high quality, but offering you better growth prospects than what some of the larger companies will offer you. And because they're middle-sized, they're not as well researched by be that the brokers, by the media, by the market. So that's really where we can find a lot of really good growth opportunities, ones whose growth prospects are more brighter than what the market perceives it to be. So just looking at performance now, performance for the fund has been good. The benchmark for this fund is the ASX 300 minus the top 20 leaders. So that is an actual official benchmark that is out there. So you're thinking the overall market, then taking out the top 20. That's the benchmark there. So as at the end of November, the benchmark did 15%, which is a super return. I wish you could do that each year. Pleasingly, we had a really good year and we're up to the end of November 30%. So yeah, we've beaten that. But more pleasingly is some of those longer term numbers that you can see there, the 3-year numbers, the 5, the 10-year numbers as well. The objective of this fund is to beat its benchmark by 4% each year. So pleasingly, we're hitting that that objective. And I wish I could say that it's going to continue to do that all the time. There will be periods without doubt of underperformance, but over sort of the 12, 13-year history of this fund, it has generally outperformed the majority of the time. So hoping that certainly continues. So looking at the portfolio and giving you some ideas of what has helped performance, one of my favourite stocks here, and you can see sort of the dodgy photo on the left-hand side that Gareth and the team might recognise. Not the 256 going up Railway Street there, but that is the Chatswood Dominoes, which is my local Dominoes, and so too for Lifestyle as well. But for Dominoes, really, this is a real typical Bennelong stock. It's been a standout for us. It's a company that's always growing their business and very importantly looking to reinvest back into themselves and provide a better product, a better service, a better offering, and importantly expanding into new markets. We got into this back in 2009 when it was trading at about $6 to $7. It's currently trading between around the $120 to $130 mark. It was up at $160 a couple of months ago, but has come down since then. Thankfully, we actually did take some profits at around that mark. It had done extremely well, but yeah, we're reasonably happy with how it's priced at the moment. But the key for Domino's has been its overseas growth. First of all, into Europe, which was into Germany, which is the second largest pizza market in the world, and then also into France. It's also in some other European markets that you can see on that table below, Belgium, the Netherlands, Luxembourg, Denmark as well. But more recently, especially over the past year, the big driver for Domino's has been its expansion into Asia, especially Japan. Japan's been huge, and more very, very recently, as in the last few months, into Taiwan as well. But Japan had traditionally been a bit of a laggard for Dominoes. But yeah, the past year, or really maybe the last 2 years, there's been a lot of work on it. They've got their management team is very strong over there now. And then also they've really improved their menus. I know this sounds kind of weird, but previously they'd kind of had our sorts of menus enforced upon them, you know, go and buy the barbecue meat lovers, or go and buy the veggie delight, or the supreme, or whatever. Now they're really tailoring their menus more so for Japanese taste. They're doing different types of pizzas, doing some weird and wacky toppings and things like that with eel, and also the quattro pizzas that they do as well. But really, it's been the story has been the store growth that they've got. Now you can actually see there are more Dominoes in Japan now than in Australia. It's overtaken Australia in terms of the amount of stores. So they're now in all 47 prefectures of Japan. They're spending a hell of a lot more money now on a marketing campaign, be that online and on TV as well. They're also looking to expand further into Taiwan that I mentioned, and possibly some other Asian countries too. Germany and France will still be massive for them. France, especially the analyst who covers Dominoes, tells me that they've still got some really big expansion plans for Japan. And I'm actually just going to read this note out for you. This is directly from the analyst Brad that I mentioned before, who covers it. The Dominoes, in all their markets, they are the largest player, and store openings and opening stores rather at a faster rate than any of their competitors, making it very hard for the competition to catch up. Having an increased store density means smaller delivery areas, which means faster delivery times and higher average deliveries per hour for their drivers, which then drives efficiency and profitability relative to their competitors. It then goes on to say that after they've spoken to Pizza Hut franchisees and Pizza Hut, Pizza Hut's head office have been saying that they're going to double stores every in the next 5 years, but they've actually been closing them. Pizza Hut sales per store on average are 40% less than Domino's, so there's been no appetite for them to try and open new stores. So for Domino's, it's all about their long-term store openings and growth prospects, and that's why we like it. So next time I come up and see Gareth and the team, I'll make sure I've got a stack of Domino's, and we'll go and sit in Remembrance Park in Chatswood near the station and eat that. That'll be our next meeting.
You're a generous man, David. You're a very generous man. Thank you.
I'll make sure I get some of the drinks as well, the 1.25 litre Coke Zeros, maybe some of the thick shakes. Moving on to a couple of others that have done really well. Now, this is your biggest position in the fund is James Hardie and ARB as well. But James Hardie's been enormous for us. It's really what's driving it there has been the strong demand for their products within the US and Europe. So we're talking building supplies here. In the US has just been enormous. They're taking market share off their competitors, and they're moving into new areas within the US where they previously haven't had an exposure. So in the northeastern states of the US, also in the southern states, especially so in Florida, where their new stucco, which is a rendered style form of cladding, is really popular. And then also over in California as well, which was hit by a lot of bushfire wildfires, as they call them over there. And so their particular cladding is cement-based, which is fireproof. And a lot of the, unfortunately, a lot of the places last year that were hit with the fires were plastic cladding made. So they've been rebuilt with James Hardie. So from all the phone calls that we have with James Hardie at the moment, from the distributors over there and the builders, that they are the #1 player in building products over there. So Hardie's has been massive for us. Likewise, ARB has been huge as well. Enormous overseas growth, the US, Europe, and here in Australia. Many of you will know what ARB do. You probably have some of them on maybe if you've got an SUV, a four-wheel drive, or a ute, etc. You'll know exactly what they do. They've benefited from us all being stuck at home, especially in Australia. So everyone doing up their utes, four-wheel drives, camper vans, caravans, etc. Those types of things. They had huge earnings growth of over 100% last year. We have taken some profits off the table for them because the stock has run really hard. But from the phone calls that we've had with ARB and the meetings with them, that the demand for their products, their factory in Thailand just can't keep up with the demand at the moment. So it's still very much a hold for us, but we have taken some profits just because it's run so hard. Then looking at a few others that have done well for the fund as well. This is one of your, the Credit Corp Group is one of your financial positions, because obviously we don't have any of the banks within the X20 Fund, but we've got Credit Corp Group. This is it's probably Australia's most reputable debt collection agency, if I could call one of those reputable. It typically buys debt off the banks, off the utilities, finance companies, off telcos as well. So they do that in Australia, New Zealand and the US, and then they'll put together some serviceable repayment plans for those people. They also own the Wallet Wizard brand as well, that you might have seen on television. But basically the stock's done really well for the portfolio. Seek has also done really well for us too, that we got into earlier in the year on the back of really strong job ad growth. Corporate travel down the bottom there on the right hand side has done really well too. We've had that for about 3 or 4 years now. They were able to manage their costs really well throughout the COVID period last year. So I did get hit obviously at the start of COVID last year, because their business is obviously travel, but it is largely an online service. They won't hit as badly as say something like Flight Centre. Manage their costs really well as we come out of COVID. Should we ever get back to life as normal, we'd expect that stock to re-rate. So we held it. We were loath to sell it. Just yesterday, they actually had a takeover. They took over the Hello World travel brand as well, if you're familiar with that. And then also to the left there, IDP Education, a stock, again, a big position in the X20 Fund. We're loath to sell it. It was the best performing stock on the market at the start of COVID last year. What IDP do, they're an international student placement company. So they will get students coming up from anywhere overseas to Australia. They will get them their uni spot. They will arrange some student accommodation. So something like in Chatswood, where you'll see where those igloo towers are right near where the station are. That's kind of an example of those types of accommodation places. They'll get them a tax file number, help them really settle into Australia. So obviously belted last year with no international students coming in. But what IDP were able to do is again, manage their costs really well, but place those types of students in overseas universities when the rest of the world started to reopen. They're also making money off their English language testing service called IELTS, that some of you may have heard of as well. Now, we're supposed to have international students, I believe, we're starting to come back in today. We all are seeing what's going on in the news at the moment, but if we do get back to, again, normality with people coming back into Australia, again, it's going to be really, that'll be very strong for IDP's earnings going forward. So again, something that we're really loath to sell there. Looking at things that haven't done so well, C-Link, which has now been rebranded as Kelsian, and some of you might be able to work out what they've done with their name there. They've just sort of jumbled the letters around, a bit of an anagram. So Kelsian or C-Link, and there's one of the brands there you might recognise, Captain Cook Cruises, that they own. They're a diversified transport travel company. They somehow missed out on 3 big contracts that we were certain that they would get. So the stock price has been hit pretty badly. Really don't know how they missed out on those contracts, but they have retained the Kangaroo Island one, I believe. It's one that we're just keeping very close watch on at the moment. Then to the right of that, you'll see BWX. This is a very long-term holding for us. This has been up and down over the year. BWX are a skincare product. They make skincare products, basically. Their biggest brand is Sukin, and you might have seen Sukin in Coles, Woolworths, Chemist Warehouse, Priceline. It's been impacted really by COVID with store openings, store closures throughout the world. But we're not going to sell it. We're in it for the long term. Sukin is now being sold throughout the UK and the US. The Boots pharmacies in the UK has been there for a couple of years, but in the US, that's a big growth market now. It's in the Whole Foods stores, but more recently, over the last few months, it's going into Walmart. So we think that's going to be very positive for BWX going forward. If you haven't done your Christmas shopping as well, please, next time you're in Chemist Warehouse or Priceline or whatever, just load up on Sukin, and you'll be doing us a big favour there. Then to 2 others, Temple & Webster, you're probably well aware of, with their really irritating television ads that drive me nuts anyway. They did really well last year for us. They're a big COVID beneficiary with the move to buying everything online. This year has been a bit more of a struggle for it. They're starting to see increased competition from the likes of IKEA, from Harvey Norman. Nick Scarley, Brescia, those sorts of players are starting to do a lot more online now. And also when we were coming out of lockdown as well, there were, we thought more people would start to go to the super centres and the home centres and that type of thing. So that sort of struggled a bit for us, and we got out of it. The reject shop also, that's a hold for us. It did struggle again during the COVID period with people not being able to go into all the Westfields and all of the shopping centres where the reject shop might be. We think it's a bit of a turnaround story, starting to sort out their supply chain issues that they had over the last year, but they've managed to get their costs particularly well. They've closed some of their unprofitable stores and renegotiated some leases as well. So that's a bit of a hold for us. And then just looking at some changes that we've made over the year. Look, one of the biggest ones that we had was getting out of resources. So you were exposed to, your two biggest resource companies were Fortescue and Oz Minerals. They did really well for us, in particular Fortescue, but we started selling that back in around about June. Iron ore prices spiking was really the catalyst for that. Iron ore started to get up to over $170 a tonne, up to 200. That was a real price signal for other iron ore producers throughout the world to start to flood the market with their iron ore to try and get that price. What does that do? Of course, that then means there's extra supply. So we decided to take profits on Fortescue from about June onwards, and we got out of it. And likewise with Oz Minerals, which is more of a copper play as well, we did really well out of it, but we took the profits there too. That was on the back of some concerns on the Chinese economy. Generally with the team with resources, they're going to be either in resources or out of resources. So once they get a good look through into the underlying commodity price, that's when they'll feel comfortable about taking a big resources position. And at the moment, we've said, no, we'll get out of resources. We will start to look at this again, which I will get into shortly when we start to speak about China. And then just really briefly, some other ones that we got out of. Afterpay, which I think, we got out of that back in February of this year. It done extremely well. Now, all of you out there listening, viewing this today, you'll probably know what Afterpay does. Some of your children, grandchildren probably use it. It's the reverse lay-by. We did really well out of it. However, it overachieved. Once it hit 150 bucks, that was something for us to start to look at. They started to face some increasing competition in the US from a lot of their competitors. We really like the management team of Afterpay, but we kind of felt as though they were just starting to slip behind some of the work that the US competitors were starting to do. So we took the profits there. Likewise, we got out of Seven Group Holdings. That was kind of during the lockdown period. We had some concerns on the Australian economy there. That's more of an infrastructure play. So Seven Group, they own Coates Hire, and also the Australian supply for Caterpillar out here too. And then I mentioned Temple & Webster, we got out of as well. Things that we bought, I mentioned Seek before. We used the profits of Afterpay to get into Seek, just on the back of really strong job ad growth. We really liked Seek, strong growth in Australia, New Zealand and Asia. So that's definitely a big hold for us. Carsales.com also we got into probably about 6 months back. That's been performing really well for us. Good quality business, only game in town really for dealers and consumers to advertise cars in Australia, and also in Korea where they've got a big presence. Benefited off the supply chain issues that we've probably all been impacted by, but especially so for cars, bikes, motorbikes. As many of you might even know, trying to get a new one into the country at the moment is taking a long time, 6 months to a year, really. So as such, we've seen the price of used cars go up. Car sales have also had an acquisition in the US as well, which we think is going to really help. And then very recently, over the last couple of months, we've got into another fund manager called GQG, which is a US-based fund manager out of Florida. We really rate their funds and their fund managers really highly. So they've actually come to the market here in Australia and listed themselves on the stock market. So we've just started getting into GQG. Finally, just some things we've topped up on. ResMed and Fisher & Paykel. Now, these have been in the portfolio for a very long time. At the start of COVID last year, they were big positions and they really helped performance of the fund. Two companies on the front line of COVID with the respirators that they make, in particular Fisher & Paykel Healthcare. As we started coming out of, started to reopen last year, we took some profits on both of these stocks. We did hold them though, we didn't completely sell them. We've decided to go back into them, just add more to them, just to add some defensive characteristics. So a bit of ballast to the portfolio, just healthcare stocks, just add those types of nice defensive nature when we, I think as we're going forward, which I'll get into shortly, in the interest rate cycle, we think there'll be a good defensive positions. A couple of little sort of nuances as well with ResMed. As the world was focused purely on COVID, many of you know ResMed, the majority of their business is actually sleep apnea and CPAP machines. So the world was focused on COVID, not really focused on other things like sleep apnea. As we've been reopening throughout the world, things like sleep apnea have started to, people that do suffer from it, have started to refocus.
Which is great. So, and mate, I'm just giving you the 5-minute warning.
Yeah,
thank you.
Much. So just getting straight into where we're at the moment, the good stuff. So a lot going on in the world. What's really concerning markets: inflation, interest rates, supply chain, and of course all these COVID dramas. Looking back over the year, what we've seen is the ASX is up, the Aussie market up about 16, the US market about 30%. Can we do, will that happen again? It's going to be very difficult. What's happened with COVID? You've seen both fiscal policies and monetary policies from governments flood the market with a lot of money, and that has helped equity markets without any doubt. Looking first of all at inflation, so then we'll go on to interest rates. Inflation's occurred, as I sort of alluding to before. A lot of you will experience that, especially if you've, or be that through anything really, but especially buying a car, bike, or a boat, but also anyone that's been doing home renovations, building costs have really soared there. And a lot of that's been due to the supply chain issues and lockdowns, with factories closing, workers isolating, borders closing. Then with the world reopening, you've had this pent-up demand and people, the demand not being demand outstripping supply rather, and the companies I mentioned before, ARB, telling us that their huge demand. Motorcycle Holdings also, who do Harley Davidson Distribution Australia as well. So we're starting to see inflation creep into services now, so hotels, hairdressers, holidays, restaurants as well, and that's largely due to labour shortages. And again, many of you will have your own anecdotes about that type of thing. Importantly, with inflation though, the two real big drivers of real inflation, so not the sporadic or temporary inflation, is real wage growth and rent increases. Now, rents are increasing, especially in the US. We're seeing this, but not really seeing the real wage growth yet. Again, you've got those examples of the hospitality workers, but it hasn't really filtered into the broader workforce yet. We are starting to, and it's really important, we're starting to see signs of supply chain improve from the calls we're having with the companies. We're of the opinion that by the second half of next year, this will improve further. Computer chip production is beginning to increase. That's really going to assist, and if we can get borders reopened, that helps with labour shortages. But inflation's here in the US, it's running at just under 7%. It'll peak in the next 3 to 6 months, we believe. And when you look at the 10-year bond rate in the US, that's already pricing that in. So inflation will moderate, but it won't get back to where it was. It'll be like sort of 3 to 4%. But at the moment where you've got 7% inflation, 0% interest rates, that can't last. So this interest rate cycle is coming, and that's kind of like what Gareth was saying earlier from what we saw last night from the US. I'll sort of just get into this really quickly. This is just a chart from the Bank of England looking at historical aggregate interest rates going back from Mesopotamia up to now. I don't know how they got the records back from the RBA of Mesopotamia back in 3000 BT, but basically it's just showing you where interest rates are. A very unique period. Some countries have started to raise them already. New Zealand, Norway, the UK were before this latest COVID drama. And as we spoke about last night, the US Fed's about to. So the US is going to raise rates 3 times, probably up to about 0.75%, or at least, or maybe 1%. They've been cutting back on their bond purchasing or the quantitative easing, but the next step is this rate rise. So what you're going to see here, and this is the important part, is that even though markets will be pricing this in, you're going to see a knee-jerk reaction to sell anything that looks remotely expensive and to either buy really cheap stocks or to go into a different asset class like gold or commodities. So you're going to see tech and biotech stocks, anything without a lot of earnings, get hit badly. Then things will calm down. The markets then refocuses back onto quality stocks that do have earnings and strong balance sheets, and these tend to bounce again, but expect a more volatile 12 months ahead. We will follow the US. We're going to be about 9 months to a year behind the US is what we believe. We are still very positive on the stock market though, and the latest round of quarterly earnings did reaffirm this. On an aggregate basis, we do think the US market will do sort of around 30% earnings over the next year, and this is really the reason why we've positioned the fund towards the US. Australian stocks that have got their earnings in the US. Huge productivity growth occurring in the US and disruption too, but the interest cycle is certainly going to be a headwind for equity markets. So it's not going to be the one-way traffic that we had. Really quickly looking at China, we were concerned about China last year. We really didn't have much exposure to it apart from Oz Minerals and Fortescue. China's doing the opposite to the US now. They're having to stimulate their economy, so they're actually cutting rates. They're looking to do a lot more spending as well. Once the Winter Olympics are over in February next year as well, we expect further stimulus. They'll probably start to increase their steel production as well. That's the time rather, is when we're going to start to look at resource companies again. We won't be able to get into Fortescue these days in the X20 Fund because it's actually moved into the top 20 now. So we might have to look at something like a Mineral Resources, but that's one that we'll keep on. We'll have an eye on next year. And then just here to Australia, look, our economy and stock market's gone from flying to being a bit of a laggard due to the lockdowns. GDP growth has gone from probably being 0 during a few months ago and up to now being 3 to 4% for the year ahead. For the stock market, we're coming off the best earnings cycle since 1983, where we saw 30% plus earnings growth. But for the year ahead, this will contract down to sort of probably 8 to 10%. And within this 8 to 10, you're going to have wide ranges. So you'll have some companies doing really well, but others that are really going to struggle. And the ones that we think will do really well are those that are exposed to overseas markets, in particular the US. So you'll just have to be more selective with what you own. Last year in the initial recovery, everything did well, but we don't think everything's going to bounce. And as I said, on interest rates, we expect that us to be sort of 9 months to a year behind. As we were sort of saying before, Gareth, you mentioned the RBA had locked in their rhetoric to 2024. They're now changing their language now. You would have noticed that last week with their statement. So we're monitoring everything the RBA say each month, but they're changing their language, and that's the first sign that we are going to have an interest rate cycle here. And like what Harry was saying as well, you need to start fixing those rates if you're going to be borrowing at the moment. It's just sort of common sense. And then very quickly, that's just how the fund is currently positioned, seeing your biggest positions there in the fund. The key takeaway there is all those 5 companies, the majority of their earnings are overseas and not within Australia. The last point I will just leave you with is from Neil Goldstone-Morris, the team's macroeconomist. He just told me to tell everyone today is to ignore the news. If you're going to read the paper, start at the sports pages. Don't read the front page news. He said there's just so much panic and fear out there, be that first of all for COVID, but for economic news as well, that the media loves to sell fear and panic. So just said, you're in there for the long term, don't panic, read the sports pages. On that note, I'll shut up and thank you again for all the support. I really do appreciate it.
No, thanks, David. That's great, mate. And I think, I presume that clients like me really enjoy the stock stories. It's nice to understand what you're invested in, and it's, I think we forget when we're investing money that it's pizzas and stuff that we're investing in. You know what I mean? And I love the ARB story. In COVID, people just went out and stuck bull bars and roof racks and tow bars, and they're doing their trips around Australia, and it's hard to see that slowing down for a while. So yeah, it's really good. No, thanks, mate. Appreciate it, and keep up the good work. Although I have to say, if you do arrive with pizzas, you know we've got to pay you back. There's no what do we call it? Soft dollar incentives in this place anymore.
Oh, gee. Come and take
Even
it to the RSL.
even a $5 pizza these days, it's
The value reign.
Anyway.
I'll
No,
PA
thanks
though.
thanks, mate. Appreciate that. Thanks to everybody for joining us today. I would just like to finish off by saying, wishing everybody a wonderful, safe, happy Christmas and New Year. And thank you for being our clients. We appreciate it. We wouldn't be here without you. David wouldn't be here without you. It's the whole cycle of life, right? So thanks a lot, and have a wonderful year, and we look forward to seeing everybody again in 2022. Oh,
Merry
I'm sorry,
Christmas.
just before I go, sorry, I should just say, our office is closed from the 24th, and we're reopening again on the 10th. So, but you know, if there's something urgent, we check our emails all the time anyway, so let us know. But thanks a lot. Merry Christmas. Cheers.
Take
Merry
care.
Christmas, everyone.
Thanks, everyone.
Bye-bye.
Bye.